Good afternoon. It is a great pleasure to have here with us today Richard Parker. He's going to give the first conference in accounting regulation and corporate governance, which we have organized now for 13 years with the Ramón Areces Foundation. The Ramón Areces Foundation has been a very strong sponsor of many of the research and transference activities that we organize at Autónoma University of Madrid. So they collaborate with some scholarships for our master students. They also collaborate by helping us to organize these conferences, which have interest both to the profession and to students. And also they help us with a research symposium that we organize for early stage scholars. Today we are glad to have Richard Parker with us. He's currently a full member of the International Sustainability Standards Board. I'm sure most of you know that sustainability reporting is no longer the next thing, it's the now thing. So it's really a very important topic. And he is also a professor at the University of Oxford, and he has published many papers, both on topics that are related with sustainability and more broadly about disclosure. He has been a member of many UK and European committees. He's also served as a research fellow of the International Accounting Standard Board, so he has a lot of experience in formulating accounting regulation. I would like to welcome Professor Richard Parker today. Of course. So thank you, everyone, and we look forward to your presentation. Thank you very much. No, it's up to you.
Thank you very much. Sorry to be slow to get up. And it's a pleasure to be here. Thank you very much indeed for inviting me. So the topic is sustainability reporting, and as you say, this is a new area, but one that's growing and developing very rapidly. And it's a privilege actually to be a part of it. What I'd like to try to do is just to convey what this world is all about, how it relates to existing financial reporting, so how the world of corporate reporting is changing. And I'd like to give you some insights into how we're thinking about this, with an emphasis on the need for thinking, because in contrast with financial accounting, which is very, very well established, sustainability reporting is relatively new, and I don't think anybody is entirely clear, actually, quite what it is, quite how it will develop, and at what speed, and so on. So there is a good deal of thinking still to be done in this space. So I'm going to sort of use this opportunity to think aloud a little bit. I would also like to thank you for allowing me to speak in English. I realize that I'm the only non-Spanish speaker in the room, so I appreciate that. Okay, so let me just start off with this slide. I'm going to come back to this slide later on, so I'm going to introduce this slide now and then come back at the end of the talk and add some more depth to it. So what this is trying to do in one slide is show sort of three different types of corporate reporting. So historically, we've only had one type of corporate reporting. The dark blue box, financial statements, is what corporate reporting has been for the longest time, right? So financial accounting as a discipline, as a subject, as it were, goes back to northern Italy in the 15th century, as you probably know. And it's been gradually refined for hundreds of years. And then when there was the Wall Street crash in the US about 100 years ago now, that's when accounting standards started, when there became a recognized need for quality and control and comparability in financial reporting. So that world is incredibly well established. And globally, IFRS is the standard setter. Not least thanks to the EU, it has to be said. So about 20 years ago, when the IASB came into existence, every country in the world did its own accounting. And then the European Union took a decision, we'd like to have the same rules across all of Europe, and so they use international standards, And then other countries started to say, actually, that makes sense. We should use the same rules as well. So the rest of the world, now 160 countries, with the exception of the US, adopted international standards. I say with the exception of the US because they were already, they were the world's leading standard setter already, large capital market, no particular need to change. But even in the US, there was a lot of convergence between accounting standards in the US and international standards. And if you're an overseas business, you can use international standards to list in the US. So there's a global standard, basically, for accounting. The two blues are rather similar in color, but there's three boxes here. The bigger box, where it says sustainability-related financial disclosure, that's where the IFRS sustainability operation sits. So international sustainability standards are broader than accounting standards, but they're addressed at the same audience. So it's also an IFRS product aimed at investors, and I'll come back to that. And then the box on the outside, other corporate reporting, multi-stakeholder focus, that embraces both GRI, which you may be familiar with, the Global Reporting Initiative, and the new European standards, about which you will hear a great deal if you don't already know about them, because they will become mandatory across the EU really quite soon. Okay, so there were three nested boxes there. There's the accounting is narrower than sustainability reporting, which is narrower than multi-stakeholder reporting. All right, let me say something about sustainability and what it is and why it matters to accounting. And I'm going to go, I've got a few slides, I'm going to go through at a reasonable pace to try to give you an overview of the subject. Sustainability is, probably the best known definition of sustainability comes from the United Nations. It's meeting the needs of the present without compromising the ability of future generations to meet their own needs. So it's about current generations not over-consuming in such a way that future generations can't consume as much, basically. So it's about the relationship between the present and the future. It's actually an accounting statement, right? If you think about accounting, accounting has a measure of capital, of equity in the balance sheet, and you make a profit or a loss if you have an increase or a decrease in equity. The logic here is society has a certain amount of resource, that's capital, and the notion of sustainability is don't deplete your capital. You can spend your income, that's okay, but don't spend more than your income. Leave as much capital for the next generation. That's what sustainability is. And then the UN also has these Sustainable Development Goals, which are all listed there. I won't go into them in any depth. Okay, and a nice little graphic to go with it. Sustainability is a very recent concern. This is incredibly long data if you look at the axis, right? This goes back a million years BC, right? So what you see is atmospheric greenhouse gas, and it fluctuates naturally over time. But what you see in the very, very, very recent history is this dramatic increase in greenhouse gas. So this is the global warming that scientists are so concerned about put into historical context. And what you see here is the very close relationship. Correlation doesn't necessarily imply causation, but I think it's fairly straightforward to infer a connection between these things. On the left-hand side, you have the same chart over a much shorter time period. On the right-hand side, you have GDP globally over the past couple of thousand years. And you can see that until very, very, very recently, sort of the 18th century where the Industrial Revolution starts, GDP is flat, right? And then it rockets, it takes off. And global greenhouse gas emissions take off at the same rate. It's not surprising because energy fuels consumption, and energy involves fossil fuel consumption. So that's what we're dealing with, and this is a measure of impact on nature. This is WWF data on, and in many ways this is more concerning than the climate data, because what you have here is decline in species count, essentially, globally. And you have this extraordinary decline, collapse, in wildlife over the past, really not very long, because about to 1970. The trend is slowing somewhat, but the level of collapse is astonishing. Now, that's the context, and it's quite difficult to see that context because all of us have been born and grown up in a period when the current rate of consumption and the method of fossil fuel use is normal, right? So you don't see this, you don't see the present situation in a long-term context. And the effects, of course, of global warming and everything else are longer term, and they haven't been felt for the most part. So we're not particularly aware of them, we don't experience them on a daily basis. That said, we are starting to see this, and you see, I don't know how much the drought in this country is associated with climate change or how much it's associated with other factors and forest fires and so on, but you're starting to see those kinds of impact. This is the economic measure of the economic cost of wildfire and of flood. And what you see, sort of illustratively, is it's starting to kick in. Yeah? So these numbers are going to get a lot bigger over the future years, but you're starting to see real economic effects. Okay, so that's the context. Meanwhile, if you think about this from an economic point of view, you think about the corporation, and which is at the heart of economic growth. So the period of takeoff of economic activity, when you had the Industrial Revolution, was also the period in time when the modern corporation came into effect. So the modern corporation dates from about 1850, and is incredibly effective as a vehicle for generating economic growth. It's therefore equally effective as a vehicle for generating environmental damage. So corporation is basically, point number one, it's a legal structure. That's all it is. It's just a clever bit of law. The structure is universal. Wherever you go in the world, the basic structure of the corporation is the same. It's that effective. Second point, we need corporations, actually, to be able to deliver the goods and services and the consumption that we rely upon. We use corporations all the time for just about everything, right? So in order for an economy to be sustainable, we need corporations themselves as an entity to be a sustainable institutional structure, or else our standard of living goes down. Corporations themselves, so corporate viability might depend on issues of sustainability. A corporation itself might only be able to survive if it adapts to the needs of sustainability. So if you look at the energy sector in particular, the transition, and energy production, not oil and gas, the transition from using fossil fuel to generate energy to using renewable energy has been and continues to be very dramatic, because there's no future in coal-fired power stations. There's no point in building. There's no economic case to building them. So there is a relationship between corporate well-being and social sustainability. However, those two things are not the same. So it's one of the best sectors you could have invested in if you were an investor in the last 18 months is oil and gas. It's done extremely well. It's changed its story about transitioning to a green economy. The story in the sector now is the world needs oil and gas for the time being. That's a perfectly sensible, economic, self-interested story in that sector, and they're doing their job. But making money in oil and gas is directly in conflict with broader societal ambition to get to net zero. So there is a conflict between the economic interests of the corporate sector and the wider interest of society, and that's at the heart of the problem of sustainability. So the final bullet here, our challenge is to make sure corporations remain viable. So you still need a system of corporate accountability to ensure that corporations are profitable and can be sustained. But you also need corporate activity not to damage the prospects of future generations. That's the challenge that we have. And that's where sustainability reporting comes in. Okay, so a first bullet point, what I'm going to do here is I'm going to describe the smallest of those three boxes on the diagram I showed you, financial accounting. And I'm going to explain why financial accounting is not enough as a system of corporate reporting anymore, that you also need sustainability reporting, and you also need reporting not just to investors, but also to other stakeholders. So that's the logical progression. So First thing, financial accounting is a system of measurement, right? It's a way of measuring the economic performance of an entity. Second bullet point, corporations are created by shareholders in shareholders' interests, right? And shareholders can be assumed to have a purely financial interest. It's not an unreasonable assumption. The corporation is not designed for shareholders. That's a really important point. Corporations are designed by legislation to serve the public interest. And the public interest, when the legal structure was created, was deemed to be best served by having a structure where the providers of risk capital have the right to the residual surplus. Anyway, but shareholders create corporations. They don't own them, they create them. And they have residual benefits. Final bullet point, IFRS is designed for the benefit of shareholders, or investors generally, for shareholders and debt holders. So it's designed to report on financial performance. The limitation of that, from a sustainability reporting point of view, is the 2 points at the bottom, that the profit a company makes, you can't just attribute to the assets that that company has, right? So if you think about, or put it the other way around, a loss isn't just attributable to them either. So suppose, a business depends upon, the success of a business depends upon having a road network, having a system of law that operates, having a system of an equitable society which is stable, and all these other things that don't belong to the entity and are not controlled by the entity. So the balance sheet, for that reason and other reasons, doesn't tell you all you need to know about the capacity of the business to make a profit. In addition, the past is the limited guide to the future. And especially in a period of change. So if we are going through what will be, or what will need to be, a dramatic sustainability transition, then how money was made in the past is not a good guide to how money will be made in the future. Historically, the way that analysts have always looked at companies is they've taken profit from the past and used it as a way of forecasting profit into the future. But if your profit in the past comes from making diesel cars and your profit in the future comes from making electric cars, and you might have been very good at making diesel cars and not very good at making electric cars, the relationship breaks down. So sustainability reporting from an IFRS point of view is providing investors with information that they don't have about sustainability-related risks and opportunities. First point here is that material information for investors in this context relates to the future. It relates to what can they expect their business conditions to be like in the future. So the reporting that we're providing is on risks and opportunities. Financial accounting reports on the past. Financial accounting reports on what did you achieve last year and the year before. What are your assets and liabilities now? Sustainability reporting says you're going to have to be net zero in 2035 or whatever you've promised. And so what does that mean in terms of your transition plan and your capital expenditure, operating expenditure, impact on your revenues, impact on your reputation, and so on and so forth? What are the risks and what are the opportunities? Critically, it's risks and opportunities, right? So we tend to think about sustainability as being all about risks, the cost of transition. But actually a future society which is sustainable, a future economy that's sustainable, is worth a lot more than a future economy that's not. And so actually there are far more economic opportunities in sustainability than there are economic risks. It's important not to lose sight of that. Okay, so the 3 bullets at the bottom. Sustainability reporting is different from financial accounting in 3 ways. Firstly, it is both backward-looking and forward-looking. It's backward-looking because something like your actual carbon emissions, the actual emissions that you emitted last year, is historical information in the same way as financial accounting is historical. So you can measure that, you can have that audited, it's a report on the past. But there's much more emphasis on the future. Second thing, sustainability reporting involves reporting on things you don't control. So financial accounting is, by definition, it's assets and liabilities that you control. That's the basis of IFRS accounting. And profit is changing the assets that you control. Sustainability reporting means reporting on anything that affects your ability to make a profit. It also involves reporting on your entire value chain, right? So suppose you're a mining company and you mine iron ore and you're part of the steel business. The actual production of steel is upstream from your business. It's that you don't own it and you don't control it. But most of the carbon emissions in the production of steel are in the manufacturing of steel, not in the mining of iron ore. So if you're in the iron ore business, the future of your, the viability of your business is heavily dependent upon the carbon efficiency of the steel manufacturer. Turn it the other way around, if you're a car maker, suppose you make electric cars, right? You're Tesla. Tesla is not a carbon neutral business. Tesla makes cars that, once they've been made, are carbon neutral in operation, or largely carbon neutral in operation. But they're very carbon intensive in production. And so you can't compare the carbon footprint of a Tesla with an energy efficient internal combustion engine car without looking at the total lifetime carbon emissions involved in both production and use. Tesla doesn't produce its own steel or its own tires or its, whatever. It doesn't mine the lithium that goes into its batteries. But those are all part of the carbon footprint of a Tesla car. Final thing, financial accounting is concerned exclusively with financial performance, whereas sustainability reporting is concerned with, from an investor point of view, is concerned with information that is related to financial performance. So if you report carbon emissions, then you're not reporting a number in euros or dollars or something. You're reporting of physical emissions of gas. Right? But those data are important to your investors because if you're a business with a high level of emissions, then you have a high transition risk. Then you're an inherently more risky business. Your potential sales are at risk. You potentially face high capital expenditures and so on. The analyst will try to estimate the effect on sales, the effect on capital expenditure, the effect on operating expenditure, the effect on whether good, young, talented people want to work for you or not, right? So the analyst is looking for financial effects, but the actual disclosures are essentially non-financial. Now then, think about all those three things: concern with the future, things not controlled by the entity, and data that are not inherently financial. And here's why it matters, right? This is a quite startling graphic. So this is, that line there shows you global greenhouse gas emissions per annum from the middle of the Industrial Revolution up to the Second World War. So you see a sort of gradual increase over time as the West starts to industrialize. You then get an enormous post-war boom and China coming on stream and so on. So we are now operating at an annual level of greenhouse gas emissions, which in order to achieve a 1.5 degree global warming needs to come down at that rate, right? That's not going to happen, actually, realistically. But nevertheless, something like it needs to happen. So what you see there is you don't get to that sharp downward line by looking at the past, right? So sustainability reporting looks to the future. It says if you're a business and you have a carbon footprint, you're going to have to change really very quickly. These are not financial measures, and climate change is not something a company controls, but it's affected by it, right? So sustainability reporting is very close to financial accounting, but also very different at the same time. Okay, so what will it look like? There will be two IFRS sustainability standards that will be issued next month, so at the end of June. The first is very general. It basically describes all sustainability-related risks and opportunities and the kind of information you're expected to disclose. I would draw your attention to the second bullet point, the TCFD structure. You may or may not be familiar with TCFD. It's the Task Force for Climate-Related Financial Disclosures. So about 5 years ago, something like that, Mark Carney, who chaired the Financial Stability Board, set up this group chaired by Michael Bloomberg with the idea of developing voluntary reporting guidelines for companies on climate change. They developed a structure, and the structure was companies must report on governance, strategy, risk management, and targets and metrics. Notice how forward-looking most of that is. And that structure is very successful as a model, and it's been adopted in here. So our standards are based explicitly around that TCFD structure. So we have a general standard and we have a climate standard. And the climate standard, I've pulled out 3 elements of the climate standard that are particularly important. One is transition planning. So it's not enough for a company to say, we're going to be net zero by 2050 or 2040 or something. What they have to do is explain how they are going to be net zero. So what is the process by which they will get from where they are now to become net zero, and what will the implications of that be for revenue and expense? What are the financial effects of that transition? So what's the plan? Second thing is they will have to do a scenario analysis and think about different transition pathways towards a net zero future and explain how those different scenarios will impact the future of their business. So again, very subjective, but very and forward-looking, but directly relevant to investors. Third thing is they'll be required to report what's called Scope 1, 2, and 3 emissions. So Scope 1 emissions is greenhouse gas emissions from your own directly controlled operations. 2 is a kind of special case relating to purchased electricity, not so important. Scope 3 is emissions in your value chain. So whether your emissions from your suppliers or whether end of use of your product or your product in use. If you think about an oil and gas company, most of its emissions are Scope 3, right? So there are quite a lot of emissions in the process of extracting oil and gas. But far and away, most of the emissions are in burning the oil and gas. So reporting by an oil and gas company would be very, very incomplete if it didn't report on Scope 3. Same is true for agricultural supply. Think about a very long supply chain. Most of the agricultural impacts are right at the end of the supply chain. So, right up the supply chain. So Scope 3 emissions are very hard to do, but the world of data provision and assurance is going to increase dramatically in this space. It's bound to. So at the moment, we don't have good information, I think it's fair to say, but I think you'll see dramatic change coming. Also, and this is really important, sustainability reporting will differ a great deal by sector, so by industry. And this is essentially why, the issues vary by industry. So this is a breakdown of greenhouse gas emissions across the global economy. Oh, by the way, this website, that little logo, Our World in Data, it's an Oxford website, and it's got fabulous information, anything to do with SDGs, really granular. If you want sort of updated information on COVID, for example, globally, there's all kinds of stuff that's on there. So what this does is it breaks down emissions currently by sector, and the transition story, the way in which each different sector will get to net zero varies enormously. So if you're in aviation, this is a really difficult thing to fix. If you're in road transport, it's not as difficult, for example. About 3/4 of greenhouse gas emissions result from fossil fuel, and the other quarter result from agriculture. And I'll come back to agriculture later because it doesn't get enough attention. Most of the attention goes to fossil fuel. So our reporting requirements will be, in contrast with accounting standards, will be sector-based as well as broad themes. So in accounting, you would have a standard for Financial instruments. You don't have a standard for banks or for insurance companies, but if you're a bank, you've got a lot of financial instruments, so you use that standard more than anybody else uses it. But IASB doesn't define a bank. It doesn't define an insurance company. It doesn't need to, whereas we do, because sustainability reporting varies by sector. Okay, what we've talked about so far is the extent to which a business is affected by sustainability. So when you report to your investors, what they want to know is, how is the profit I'm going to make from my company affected by all these new big trends and changes that are taking place? We call that dependency, right? So the business is dependent upon not having wildfires and floods and things, for example. So it's dependent upon having a reliable supply chain. It's dependent upon having well-trained employees and so on. But a business, it doesn't just depend on resources, it also impacts those resources. An impact is when the activity of an entity affects other stakeholders, affects the interests of other stakeholders. The real concern is when the impact is negative. So if you go back to the definition of sustainability, if sustainability is all about not harming future generations, then an impact of a company that destroys the resources of society most affects the capacity of future generations to benefit from those resources. So it's a negative impact that's important. Dependency and impact are related, because if you have a strong negative impact on society, it's going to be harder for you to operate in an ongoing way. At some point, you would expect people will stop buying from you, or governments will start to tax you, or people will stop wanting to work for you, or something, right? So to some extent, you can expect externalities, external effects, to become relevant to investors. But they're not the same thing, right? So the extent to which a company depends upon resources is not the same thing as its impact on them. You see that in particular at a really macro scale. If you think about the countries of the world that have most caused climate change, it's the developed West. If you look at the countries that are most impacted by climate change, it's the global South. So if you're somewhere like the Maldives, Maldives famously is going underwater and will cease to exist, right? They have not been the world's greatest greenhouse gas polluters. So their impact is tiny. Their dependency is huge, right? And big Western companies have been the opposite. Okay, so is it enough to report to investors? Is it sufficient to say to corporations, tell investors how you're affected by sustainability, and that does the job of sustainability reporting? So for reasons I've just described, this is the first sentence here, externalities can be material to investors. So if you're in the car industry, the fact that the world is trying to transition to net zero is dramatically affecting the economics of that industry. It's going towards electrification very quickly. This can have social effects as well. Let me tell you an anecdote. So in Oxford is where the Mini comes from. The Mini was invented there. It's been made in a factory outside Oxford forever. I'm not sure when the Mini came into existence in the 1960s. So every Mini all over the planet, with a very small exception, was made in Oxford. BMW own the Mini business, and they have just made the decision to make the electric Mini in China, right? Now, meanwhile, the UK has a law which prohibits the manufacture of internal combustion engine cars after 2035. What that means is that whole business shuts down, right? That's a sustainability-related social impact, because the Mini business is adjusting. It's also a Brexit effect, right? But the Mini business is adjusting to the effects of sustainability. Okay. So externalities do matter to investors, but they don't matter enough from a social point of view. So, take the first point. Externalities are incurred during transition. If you think about the oil and gas business, the oil and gas business has been pumping greenhouse gases into the atmosphere for 100 years or something, longer. And all of the profits from that have been earned and distributed and mostly spent, right? The fact that the oil and gas business, at some point in the future, has an incentive to become a renewable energy business doesn't really help very much, because between now and then, it will continue to be a source of emissions. Second point, while society needs the corporate sector as a whole to be sustained, and while the corporate sector as a whole has a self-interest in being sustained, because the corporate sector is a part of the economy and the overall well-being of society is very closely related to the well-being of the corporate sector, the same is not true for an individual company. So if you're a successful oil and gas business, maybe your best strategy is to carry on being a successful oil and gas business for as long as you can, and then stop trading altogether. You don't need to become a renewable energy business, you can just go out of business. So it's not in the interest of an individual corporation to be sustainable as an end in itself. It's in the interest of an individual corporation to make as much money as it is possible to make, as it should rightly do under the legal structure. So economic incentives are firmly embedded into the way corporations are set up. If you're a company, you have a legal obligation, right, not to ignore the interests of your investors. That's one way of describing it. So the sort of Milton Friedman doctrine, which you may be familiar with, is not wrong. He's often criticized for being wrong, but it's not wrong. It's a very clear statement of the economic incentives of the corporate sector. The emphasis in the Friedman doctrine is that the public sector doesn't govern the private sector well enough, but it's not a criticism of the operation of the private sector. Okay, this is just a very simple graphic to illustrate a very complex set of interactions. The idea is all sustainability issues start with human activity, the left-hand side there, human activity gives rise to two types of impacts on the planet. One is greenhouse gas emissions directly from burning fossil fuel, and that's mostly industry, buildings, and transportation. Human activity also changes land use, and that's mostly through agriculture. And the effect of land use is not just on global warming directly through greenhouse gas emissions, reducing carbon absorption, and so on. It's also an effect through the impact of agriculture itself, which is a very damaging industry. And of course, there's a devastating effect on biodiversity. So you have a global warming effect and you have a change in land use effect. And those are the drivers of sustainability-related concern, primarily. Those things lead to, in the big box, all kinds of change. Water changes in the water cycle, where it rains and where it doesn't rain, and why, rises in the sea levels, and so on. You can go down the list. Invasive species is an important one. I just learned yesterday there are no native honeybees in the UK apparently because of invasive species and disease that comes with those native species. So these are the kinds of effects which take some time to work through the system, and we're kind of in the middle of that now. The thing on the right is what happens in the end, right? So when you start to have no water in between India and Pakistan, and Bangladesh is underwater, then you start to have some very nasty consequences. So that's what's down the road, and what we need to try to avoid somehow. I mentioned agriculture, and I just want to describe very briefly, there's only a few slides left, very briefly, that agriculture piece, because it is very understated in relation to carbon emissions, but very, very important from a sustainability point of view. So getting the mindset shift, whether you're an investor or whether you're a stakeholder affected by corporate activity, understanding what's ahead and what needs to change between now and the future is what sustainability reporting is all about, making transparent. So this, again, from the Our World in Data website, this is a graphic of land use over time. So you see the top chart is 10,000 years ago. So the whole of the planet was forests and grassland. 5,000 years ago it was the same. 1700, that's when you start to get the Industrial Revolution. By 1900, quite a lot of land is agriculture. By now, 46% of the land that was once forest or grassland is for agricultural use, of which 31% is livestock and 15% is crops. I think the livestock number includes crops grown for livestock, by the way, I think. So, another way to look at this, of all of the surface of the earth, about 30% is land, of which about 70% is useful land, of which 46% is agriculture, of which 77% is livestock, which provides 18% of global calories, right? So we have this massive increase in land use, which produces food very inefficiently for human consumption. Because we've always done it that way, and it's never been a problem in the past. So if you're an economist and you're familiar with the notion of a public good is where consumption is both non-rival and non-excludable. In other words, one person can't stop another person from consuming, but the consumption by one person doesn't affect the consumption by another. So until really quite recently, most natural resources were public goods. So you could chop down as much of the forest as you like. Nobody can stop you, but then it doesn't affect anybody else because there's so much of it. What's changed is that natural resources have become what economists would call a common pool resource. In other words, they're non-excludable, but they've become rival. In other words, the consumption of one person is at the expense of the consumption of another, or in particular at the expense of future generations. So there's a very dramatic change in the economics of natural resources. And this is the most obvious example of it. So meanwhile, just to give them a couple more slides on this, meanwhile, deforestation is primarily driven by livestock, primarily driven by beef. And this is not just for grazing land, but also for food for grazing. The Amazon, I'm not sure if you've heard of this, this Amazon dieback, right? So the Amazon is a very delicate ecosystem. I'm not an ecologist, so this will be a very limited explanation. But it generates its own rainfall. It has its own climate, in effect. When you start to reduce the size of the Amazon, it starts to lose its capacity to generate its own climate. It ceases to be able to cool itself quite so effectively. It becomes more vulnerable to getting smaller at a faster rate. So it's what environmental scientists call a positive feedback loop. And there are several very concerning positive feedback loops in sustainability. The estimations are that once the Amazon gets to about 20% depleted, that triggers a cycle, a feedback loop, which destroys the whole of the forest. It ceases to be viable. There are two states of existence for that part of the world. One is forest, and the other is grassland. So it could, in principle, become savanna grassland. Currently, the Amazon is deforested by about 17%. Right? So we're quite close to what could be a disastrous tipping point, but we don't know. So, and that kind of effect is very common throughout sustainability. You see the same thing with the melting of the polar ice caps and so on. Meanwhile, and this is a separate point, but livestock is a particularly powerful source of greenhouse gas emissions because of methane. Methane, over a 20-year period, is 100 times more powerful than carbon dioxide as a greenhouse gas. So what you see, it doesn't last as long in the atmosphere. That's the good news. So what you see here is the impact of different sources of food on greenhouse gas emissions is enormous, but very, very not widely known, I think not widely understood. Meanwhile, and this relates to the economic incentives of corporations, the wealthier we become, the more we become like meat and dairy consumers. That's normal. That's always been the historical pattern. Until you get to a wealthy society, then it tends to level off, right? So Western economies in Europe, you see the trend dipping. But if you're a low-income country, the problem's getting slightly worse, and the wealthier you get, the greater the problem is becoming. So point being, the whole thing is very unsustainable, but is built into the economic incentives of corporations and not well understood. So in a sense, the theory of change for sustainability reporting, whether you're reporting to investors or other stakeholders, is you change the economics of the corporation by creating greater awareness of the sustainability-related issues. Okay. European standards, which are under development, the Commission will put them out for sort of final consultation in the next couple of weeks. European standards are world-leading, actually, in capturing impact of corporate activity. So European standards, when they come in, will both be based on reporting to investors and based on reporting to other stakeholders. That's what's called double materiality. There's a lot of pushback on these because they are extremely ambitious in a very short period of time. They cover all sustainability issues. They're going to be mandatory. They will affect not just companies which are based in Europe, but also overseas businesses operating in Europe. So there's a lot of anxiety in the US and other parts of the world about the implications of these standards. The challenge for sustainability reporting, from our point of view, is having international and European standards working together and aligning what's called interoperability. Okay, back to this. So the dark blue box is what we're used to. It's a system of accounting that worked well throughout the Industrial Revolution, and now it doesn't work so well anymore because we're facing a sustainability transition. The box that's wider than that is about reporting on sustainability insofar as investors care about it, insofar as it affects the ability of the company to make a profit. So that's the space that IFRS is in. It's also the space that the United States SEC is in. So they have a climate disclosure rule, which is going to come out shortly, we think, aimed at investors. The box on the outside, where you see ESRS and GRI, that's aimed at reporting not just to investors, but also to society more broadly. So if you're a company right now, there are various things you might be doing. There's some examples across the top. What you're going to end up doing is a global baseline of investor-oriented reporting, which is IFRS, to go alongside your financial accounting. And IFRS will be done alongside both GRI and EFRAG ESRS. Quite how that's going to evolve over the next 2, 3, 4 years remains unclear, actually, but that's broadly speaking the direction of travel. Let me pause there and see if you have any questions. Yeah.
This is in the voice of EFRAG. I am involved in the European Sustainability Reporting Standards, particularly in the development of the computing format, the XII taxonomy. And we have, I'm an IT expert, and we have a question. In the financial statements, the information are figures. In IFRS, the financial statements are figures. Only the notes are natural text.
Mm-hmm. Yep. Yep.
However, in sustainability reporting is just the opposite. Most of the information are, at least in European sustainability reporting standards, most of the information are textual phrases, paragraphs, and not so much information are figures. From an IT point of view, the comparability of figures is one animal, and the comparability of natural language is a very different animal. Yep. Why? And we asked to the domain experts to put figures, not natural text. But they say something, and we, the IT experts, don't understand very well where is the problem to put figures in sustainability reporting. Thank you.
So, two thoughts. One is that there are two different types of figures. there's monetary, and there's units of other types of units, right? So sustainability reporting has always had non-monetary metrics of one kind or another, whether that's tons of pollution or tons of greenhouse gas emissions or percentage of women on the board or whatever. A problem with that kind of metric in relation to monetary is you can't add them up, right? In the financial accounting, everything gets added up. Now, the gap that S1 and S2 are trying to fill is connecting the narrative and the non-monetary measures in sustainability reporting with the kinds of financial metrics that investors want. So the idea would be, don't just say we want to reduce our levels of pollution. The idea is to say, report metrics on those that auditors can audit, but also tell us how it's going to affect your financial statements. Tell us what the implications are if you're an investor for those things. So the transition planning and scenario analysis and financial effects are all disclosures that are part of our standards that will change that very significantly. Now, having said that, transition plans are about the future and financial accounts are about the past. Accounting has never done the future because you can't measure it reliably. And so accounting has always been very nervous about forward-looking information. So we don't yet know how good disclosure will be, how good assurance will be, and so on. This is a very new and emerging space, but that connection between the narrative and the financial is very much the space that we're trying to fill.
So two questions. One is, you've mentioned that there is going to be this reporting on others, right? Because you're going to report this level 3 supply chain. So suppose you are a supplier to both me and Begoña, and so we have to make an estimate of your impact on alone our. So what coordination do you foresee will happen here, or uncoordination, and what consequences that?
It's a really good question, and we don't know, right? So there was I'm not sure if this is just a US story or it's broader, but a perception that chief executives were paid too much, right? And so the solution was disclose chief executive pay and disclose it in relation to everybody else's pay. And the unintended consequence of that was, because everybody thinks their chief executive is top quartile, everyone's chief executive's pay kept getting ratcheted up every time there was a review of their pay. So the effect of introducing a requirement to reduce the pay gap massively increased the pay gap, right? So, and you'll know lots of other examples of unintended consequences like that. So it remains to be seen what the impact will actually be, We'll see.
You could even think of moral licensing, right? Like you feel moral license in a way, right? You think, because all these people are contaminating this much, right? I'm doing okay in a way. But the other question is, because in accounting, right, we report on this year and past year. This is what's typically on our balance sheet income statement. Yes. What's the time frame for? It's the same.
There'll be the same requirement to report the current year and prospective and last year. One difference is in financial accounting, if you revise an estimate, you make the change in this year. For sustainability reporting, you would revise the number that you got wrong in the first place. So you have better trend data. Apart from that, it's the same.
Well, thank you. Thank you very much for your presentation. So I'm just curious about the SDGs,
yes.
The United Nations Sustainable Development Goals, because actually I'm working on that, but it's like the same as my colleague, like working from text analysis. So my question is that is in the future any effort to try to combine or to try to match each SDG with a particular analysis or value?
Yeah.
Thank you.
Again, it's a good question. The way I would, in my mind, there's a difference between the Brundtland definition and the SDGs. So the Brundtland definition is a very clear, as I described, a kind of accounting type statement, whereas the SDGs is more of an aspirational, this is the way we'd like society to be, right? And a challenge with them, which is also a challenge that we will have once we get beyond climate, is that there is so much interaction among them, and you can't expect any one entity to prioritize all of them, right? One of the risks of that is that companies will pick and choose the ones they have a good story to tell about. So they're actually quite difficult things to benchmark against and pin down, even though they're quite a good general statement of direction of travel. They also combine, it's natural and social and economic as well. So, you could very readily justify business as usual by focusing on the economic SDGs rather than the others. It'll be interesting to see what replaces the SDGs now they're starting to get close to completion.
Thank you for the presentation. So the challenge is massive.
Yes.
It is massive.
Yes. Unprecedented.
And what my question is, I have two questions. Is reporting enough?
No. No, it's not.
It is not enough.
No.
And so that thank you.
I think it's, you might think of it as a necessary but not sufficient condition. So if you don't have standardized data and transparency of data, it's very hard to make progress. But in itself, no.
Right. Even if there is transparency, well, it's a shame if you don't do things well, but you can still report that you are not doing well and do well in financial terms.
Yes. Yeah.
So I am wondering, the whole exercise and the whole industry I see is how to make investors more responsible.
Yeah.
And so my question is there somewhere in the world discussing about the reasonability of limited liability, meaning you want to make investors more responsible, but still they are liable up to what they invest.
Yep.
But the externalities can be a lot more.
Yep.
So it's not a fair share.
Yep.
In this case. I wanted to know whether somebody is discussing this.
So, the limited liability company was introduced when natural resources were public goods and not common pool resources, right? And the world's changed. It's a very, very difficult thing to do, to change the structure of the corporation given the extent of vested property rights in that structure. The B Corp movement and so on is an attempt to try to do that. And not surprisingly, a kind of significant but very limited success. I think realistically, you have to change the economic incentives because, for both investors and corporations, because they are, as institutions, they have very, very little, if any, flexibility other than to follow economic incentives. And so one source of change in incentive would be the ultimate beneficiaries of pension funds and so on changing the mandate to say, we want you to invest in this and not in that. Consumers changing behavior, employees changing behavior, and more than anything, governments changing behavior. So the economist's solution to all of this is tax, right? And tax has a very bad reputation because it's associated with taking money away from people, but of course a tax doesn't do that. Tax takes and gives at the same time. That's the whole point of the system. So the absence of redistribution away from damaging industry towards supporting non-damaging industry is a failure of government. But again, you change government incentives, you change public policy, you change economic incentives, then corporations will act. I think the great strength of corporations is they are able to adapt so quickly. Markets are so powerful once they get going. And the electric car industry is a really good example of that. But if they don't have the incentive to do it, then they'll make electric cars over here and SUVs over here, right? Which is what's happening now. So I think for me, the role of data, the role of information, is helping to enable that change in economic incentive in everybody's interest. You don't look convinced.
Sorry?
You don't look convinced.
I would prefer that the measures are taken to the investors as well. So towards the investors as well, but because you are talking, well, the market should drive, or the government should drive, or...
Yeah, but most investors are told, go and get me the best financial return. And that's, they're under a client obligation to do that. So, it's a product of the system, I think, more than anything else.
Yeah, no, about limited liability, that should do the job, I think.
Difficult. I think my sense would be it's more difficult to change that than it is to change market dynamics, is my hunch.
Okay, thanks.
Other topic, as we have apparently some time, is comparability. I make some academic research with the information of the Security and Exchange Commission, also the information of IFRS in the European implementation in European single electronic format. And in my research, the comparability on IFRS is limited.
Yep.
Why? But from an IT point of view. Why? Because the reporting entities select the concepts. Instead to use the typical statements prepared for IFRS, they pick up the concept that they prefer, and they are not concepts common in all the annual reports, except the name of the entity or assets. Very few concepts are common in all the entities. We are afraid with the sustainability reporting for the topic of comparability.
So,
ideas about?
Yeah, so I think, again, I would say standards are, again, a necessary but not sufficient condition for comparability. So I was in a meeting with several banks last week, and one of them described, that they need to understand their financed emissions, right? So the carbon emissions of their portfolio of invested companies. And this guy said, look, we can do that. We have to go to all of our clients to get this information. So we need to have a standard to be able to do that, even if we have to develop it ourselves, right? We can't do it otherwise. It would be better if we use the same standard as other banks in the UK, and if they use the same standard as other banks globally. That will make everybody's life easier. So the standard is the most efficient basis for comparability. But you don't get comparability unless you have comparable practices and enforcement, critically. So a reason for a lack of comparability in IFRS globally is because enforcement differs globally, and that's not something that we can directly control. So again, it's a partial but important step, I would say.
So if there is no further questions, then Richard, thank you very much for being here today. I think this topic is really, really massive, right? So we really appreciate the very interesting presentation that you've given, and you've given us a lot of thought, I think. So also to be depressed for the rest of the afternoon. So.
Yeah, it's, there is a lot to think about. It's complicated, actually. And you know, part of it being new is that it's complicated, it needs thinking about. But what I would also emphasize is the growth and opportunity in this space. If you compare financial reporting and all the people employed and all the institutions and all around financial reporting, and you compare that with sustainability reporting is tiny, right, in comparison. But it's going to become very big very quickly. It has to. So it's a good space to get on top of early, actually.